Good morning, everyone. This is the Annuities Basic session. I'm Pete Weber. I'm the Life Actuary at the Ohio Department of Insurance. And this is Fred Anderson, the Chief Life Actuary at the Minnesota Department of Commerce. And what we're going to go over today is some, very, as it's described, the annuity basics. And, I'm sure some of this will be very basic for many of you, but also it's probably, annuities are very complex products, so that hopefully that's a nice balance here of basic and kind of something for everybody. Let's get. All right, so if you're going to have an annuity basics session, you're going to start with what's the definition of an annuity. So if you go to Webster's or Investopedia, you'll find that a definition pops up as a type of insurance issued by life insurers that will typically pay a monthly benefit to a person, typically only if that person is alive. And that first one, I think, is what maybe most people probably think about as an annuity. But I think the second part is also kind of important because most annuities are savings instruments, so kind of an investment component here, designed to first accumulate funds and then systematically pay them out over one's retirement years, to accumulate those funds and pay them out systematically or in a lump sum. So I'll say, as I was kind of preparing for this, I did a very informal survey among like family and friends to see what they knew about annuities or what their if they had an opinion, favorable or unfavorable. And it was pretty clear that when I talked to my kids and some of their friends about, what an annuity is, they really had no idea whatsoever. I think my daughter kind of got at it when she said, "Oh, isn't there a commercial? It's my money and I want it now." And I'm like, yeah, it's kind of. You're certainly in the right ballpark, but not really. So yeah, the younger you are, you're just not thinking about this stuff. But when I talk to like my friend circle and my siblings, they were more aware of it as the retirement asset, something to for your retirement, and you're trying to think about investing for that and kind of more in both the payout phase and really the lump sum phase. You're trying to think about what to invest in and where to get a return. So it kind of gets down to, well, how does the purchaser intend to use it? Will it be that insurance piece where they expect to sort of take a large lump of money and turn it into a series of periodic payments to receive to kind of replace their income in retirement? Or do they just intend to take a lump sum payout, kind of get past the period where they might get charged and for taking a surrender and getting it out and then looking for another place to put it? Let's see. There it is. This is the one. I kind of started playing around in clip art and decided to give it for a visual here. You've got a big bag of money, and you will give that to the insurance company, and they turn around and simply come up with a series of periodic payments, typically monthly. Could be other forms. But back to this one, yeah. So some considerations to the definition of annuities is as you think about potential retirees as they're growing their retirement funds. They have these big bags of money, and there's a lot of out there, who are interested in getting their hands, and insurers are just one part of the retirement. And in investment and financial groups that want to get access to that money. Banks, there's certainly, you could invest with banks and deposits or, directly into mutual funds. You could directly purchase other assets like stocks and bonds. And that's kind of what, sort of that left side, the big bag of money, what you're, looking to kind of accumulate and have for your retirement years. You're looking at there's certainly different areas where you can invest that. And an insurance annuity is really just one piece of that. There's also, if you're thinking about insurance as the alternative to the insurance piece, It's an alternative to a pension and Social Security. Again, the fixed income, the right side of that equation, this is really a replacement of your income and an alternative to these other forms, because certainly over the years, pensions are becoming less and less. I've seen a number that maybe 20% of current positions have a pension. Getting a lot of public sector, I think there's still a pension sort of out there. But yeah, so you just, again, annuities have really evolved recently because of the lack of pensions offered by employers at this point. So we saw this one. Apologies, it jumped around a little bit. Oh, and then again, more fun with clip art here. The annuity as an investment, if you think about it, you've got your big bag of money. It's going to mature. To that same big bag, you protect your principal, but you are going to be paid some credit by the insurance company. The fixed or non-variable annuity is really more for kind of principal protection. The variable annuity, you start with that same bag, and the annuity contract holder takes on all the risks. So you may grow it into be a large bag, or you may actually lose principal in this case. But over time there have been, and we'll get into some of these, the ways that companies have taken some of the risk away for the purchasers of these variable contracts. So yeah, let's talk a little bit about the annuities. Annuities reputation. This was a little different than my notes came out, but here they are, I'm caught up. I guess again, thinking about when I'm kind of nearing retirement age, if you couldn't tell. I've started kind of thinking about this and doing some research on YouTube, and and there's certainly a wide range of perspectives out there about annuities, good or bad. What are they? And if you've heard, there's really as much financial advisors as entertainers. Like Dave Ramsey is one that pops up, Susie Orman. Folks that have very strong opinions and take field calls from potential retirees. Oh, what should I do with my give me some financial advice. And they happen to be two people who are adamant against the annuities. It's funny when someone calls in and says, "Well, I'm thinking about putting $100,000 in an annuity," and they lose their minds. Some of the reasons that they give are the fees, they're very significant fees, and I think that's probably one of the biggest complaints relative to just sort of purchasing a CD or investing more directly. You'll hear that from financial advisors who have other forms out there where maybe they could get paid instead of sending commission or fees off to the insurer writing the annuity. But there's lots of fees, commissions. They also potentially reduce credited rates. Another big problem is the early surrender charges kind of limit flexibility, at least early on when you purchase an annuity contract. Kind of thinking back, one other thing I wanted to mention when I was thinking about kind of my experience when I first got into insurance, kind of back to the definition of what is an annuity. I had just started at a big company. They wrote a lot of life insurance and annuity products. They had P&C as well, but I was a life actuary. Taking exams, I got a job. I was good at doing math problems, and that was about it. I didn't really understand insurance at that point, and we would get together periodically, with all different other actuaries and talk about, some education to kind of get educated on things. And I remember when I was first heard about annuity products and what this company did and how they were doing a new product, and it was going to try to roll things over from the other one, and I was kind of scratching my head because I was kind of thinking of the definition of an annuity was a series of payments. I mean, that's kind of where my mind was, kind of consistent with the younger people that I talked to, my kids, about what they thought of about their perspective on annuities. And it kind of blew my mind a little bit that, well, wait a minute, you mean people are buying annuities and they're not annuitizing them? I mean, isn't that the definition of an annuity? And it kind of gets back to, well, no, not really, because as much as that's a part of it, It's really that, large lump sum, your retirement investment, and, and how interested all the different areas are about getting access to that lump sum. So I thought that was something else that came to mind when I was thinking about this. So I don't think it's an all bad reputation on annuities. There's certainly some positive features. For example, folks very risk averse maybe are very drawn to the guaranteed income for life aspect that annuity provides. They also are very can provide very customizable payout options. You have a married couple, say, and you can set it up to pay until the last one dies, only till the first one dies, till some maybe half or some proportion continues to be paid while after the first died and the second lived. So there's lots of different customizable payout options that you can with these. The potential for tax deferral during accumulation, that's a very big part. A lot of but then again, a lot of just like a lot of other retirement investments, you get to defer your taxes until you actually start using that money. It can offer access to very unique investments. They can kind of set up things, and we'll get into some of them, like fixed indexed annuities, different ways to credit interest, and again, thinking about how your savings, your retirement savings dollars will grow. I mean, there may be certain ways and certain timings that are offered by annuities that you can't get elsewhere. And kind of the last one, it's important addressing retirement security. I've heard lots of different numbers out there about how Americans are underfunding their retirement, and if there's a good annuity market that provides good, safe products, valuable products, if we can get more folks to purchase those, then you've kind of gone a ways in addressing some of that. All right, so let's talk now about just some very basic products. And there's a lot of ways you can slice and dice the different products that are out there, but this is kind of a way that I decided to cut it up, sort of at the very beginning. And again, and this is when you're in the accumulation phase, you're thinking about, excuse me, how your product will get credited with interest and grow to become that big bag of money that you want to turn around and either reinvest or get paid out on. The fixed annuity is pretty basic. It goes way back in time. Fixed rates are declared annually. There's a minimum interest rate. It's greater than zero. It's declared at issue. So what all that means is that, yeah, you'll get some minimum guaranteed rate, but every year the company will look at what its general account assets are producing and will say, well, we can afford to pay you, some interest credit, 5%, 3%, 6%, something in there. Whereas then a fixed indexed annuity is a credit based on the index performance. So rather than just looking at what the assets can produce to credit your annuity contract, you purchase an indexed annuity that looks at an index, let's say the S&P 500, okay, well, if that went up some amount over the year, we will credit you that. Well, they can't, if they're only crediting you the upside, and that fixed is an important word there because the floor is still zero. Again, remember, fixed kind of implies principal protection, so you're not going to lose money on your investment and the the investment earnings portion of that, but you're looking at, okay, well, what can I earn? So as the index goes up to say the S&P was up 20% in a year. Well, in order for the company to purchase assets, they purchase hedges and other types of assets that will allow them to sort of credit you an amount near where what the S&P returned over the year. But because they're guaranteeing that it's a zero floor, they will not, credit you unlimited upside. What they will do is put a cap or a floor. A cap is simply, well, we'll cap this at, say, 10%. So if the S&P went up 20%, your max, you will only get credited 10%. If it only went up 5, you only get that 5. But the kind of safe feature of this is that the 0% is if the, clearly if the index went down, you get a 0 credit and you don't lose any principal in that portion of it. So variable index annuities, I'm going to jump down to the bottom one first because that's really the simplest one, where if you have a simple traditional variable annuity with none of these guaranteed minimums benefits kind of applied to it, it's simply you are investing in the stock market. You are often an insurance company's separate account, and whatever that returns, that's what you earn. So you could lose, the S&P is down 40%, your account is down 40%. That's what gets credited. But then there's the unlimited upside. So these are definitely listed in an order from least risky to the purchaser to most risky. Okay, so I jumped over variable index annuities, or they're also called registered index-linked annuities, or RILAs. It's a common term that's thrown around. These are kind of in between, and they really are very much a fixed, or they very are much an indexed annuity, as the name implies, but the floor, I should say, is not 0. They've come up with another floor that allows the purchaser to take on some risk, but not the entire risk of the separate account of the stock market, say. What happens there is you might have a floor of, say, negative 10%, which means instead of if the market drops at all that it's floored at 0, no, it's floored at negative 10. So you could actually lose up to 10%. In return for that, again, risk reward, you have the caps are generally higher. And the participation rates will be. I didn't mention participation rate. That's another term. The participation rate is another way that companies sort of offer up some protection and at the floor and sort of limit the upside potential. A participation rate means if you have, say, a 50% participation rate, the highest that you'll earn in for example, if the S&P went up 16%, having a 50% participation rate means you only get an 8% credit. You're only participating that percentage in the upside. But, again, if it's a fixed index, you'll have a 0 floor. In a variable index length, you could have a negative floor. Buffers are another design that are out there, and those work in that you are buffered, is the best way to describe it, against drops in that index. So in a case where the S&P may have, if you have a 10% buffer, if the index drops, say, 5%, well, you have a 0 credit. If it drops 10%, you have hit your buffer and you're still at a 0 credit. Your losses only kick in when you go past that buffer. So if you have a RILA that has a buffer that is, say, 10%, if it loses, if the S&P in that year is down 15%, you are only credited negative 5%. Again, it sort of absorbs that first 10% of loss and credits you based sort of after that point. So again, as companies try to differentiate themselves in the market, they come up with lots of very clever ways of crediting interest, and some can become quite complicated. These, there's more out there than some of these that I've described, but these are sort of the basic general ones that I kind of think about. So yeah, that prior one was sort of as you think about as you accumulate funds, the accumulation portion of your annuity is what I just described, but the payout annuity types, let's talk about a couple of very basic ones. These are much more basic. If you hear the term immediate annuity, that just simply means you have turned over your single premium, that lump sum, that bag of money to the insurer, and they are now paying you a guaranteed stream of future premiums or future income that you've turned in. So you are kind of in payout mode, and that's your immediate annuity purchase. You've purchased that portion of it. Longevity, or deferred income annuity. These, aren't terribly common, but I felt like throwing it in here because this is sort of a product that looks at kind of a very special market need that I've got enough funds to cover me for a period of time. I'm more interested in my longevity and going beyond when I may have life expectation. So you will hand over a lump sum. Again, no one would ever take their entire retirement and send it into one of these. But if you're looking for some protection much further out, you actually purchase this. And what's unique about this is you may not get a penny. If you pass before you reach the point when this longevity annuity would kick in, well, it's kind of like term insurance. You may pay a lot over your life for term insurance and never use it. And that's probably a good thing, but it also provides you peace of mind. Well, this longevity annuity gives you that peace of mind that, okay, I'm not going to outlive assets, and that I will have something after some point. Then the third one is cheating a little bit. It's a deferred annuity with guaranteed minimum withdrawal benefits or living benefits. These aren't typically considered payout annuities as much, but we'll talk more about these later, but it basically allows the purchaser to retain some liquidity in their annuity contract while they're beginning withdrawals of it. So instead of, and this became very popular in the early 2000s when markets were moving all over the place, the concept that, I don't have to just hand over my entire bag of money to an insurer and then wait for these payments to come out. I can start taking payments, and I can guarantee those payments for life, but I still retain some of the liquidity. I still retain access to a big part of that big bag of money for other things as they may come up. All right, and this I think is a kind of a neat slide because, as a consumer, and this is from the perspective of the consumer, excuse me, sort of looks at sort of fundamental, theory of economics. I don't know. You win. The more risk you take on, the higher the potential return expectation, or a way to look at it, that is, in order to have access to higher potential return, you're going to have to take additional risk. And these are simply those same sort of annuity products I laid out before in a line, and you can see kind of the highest risk and highest reward are those traditional variable annuities that I described. Again, you take the full up and down of the market, whereas the immediate annuities are really the safest. And you've kind of already locked into your future, and you've lost, the risk is low. You've already kind of set up to what you're going to earn, and then they land in between. So I just think this was a kind of an interesting way to look at it. All right. And this slide again, I guess, as we're looking at annuity basics, I kind of wanted to look at, what has sort of the history of, and this breaks out fixed and variable annuities. Hopefully you can see some of that. It starts back in 1999 and comes forward to just last year. The green line is fixed, and the orange line is variable, and then the blue is just the combination of the two. And you can see some patterns here. Nothing gets, things bounce around. It looks like in 2016 or 17, fixed jumped above variable for the first time, and then in 22 from 21 it really took off. And while this is an interesting slide, this one unfortunately is kind of small, but hopefully you can all see that. I simply took that previous slide, put it on the top, and then I looked at, okay, what was the economic market doing over that period? And if we think back, the red line is the S&P at the bottom chart, and the blue line is U.S. Treasury rate, which is an indicator of what kind of fixed rates might return. If you look at that, again, you kind of lose it in the scale a little bit. But if you look at around 2000 on the very left side of the graph, around 2000, 2001, 2002, that was a very bad sort of series of market years. The S&P was down. It's, again, kind of hard to see, but it was up near 1,800-ish, and then it was down below 1,000. So you actually really lost. That was the dot-com bubble and bust. So there was a lot of it. And then, 9/11 at that point was really wreaked havoc on the market. So that's sort of the S&P. And then you can kind of see fixed. If you look at the top, it's like, whoa. So people were becoming a little more scared of the variable. So they're, not in a big way, but the fixed definitely took off at that point. So then move forward to 2008, the financial crisis. You can see the S&P dropping pretty significantly, and really more of a blip in the red line above the variable. It definitely dropped. Folks are like, okay, I want to do, I don't want to be putting my money in the market at this point. And fixed, didn't all go there, but it just, kind of see what happened with sales there. But over all that time, you can see that blue line just steadily trending down. Yeah, it really dropped when the financial crisis hit, but it continued to drop down. It rebounded a little in 13, and then, we see where we got to in 2018, 19, and 20 in particular, excuse me, with COVID. And you had a period of time where you had really, fairly historically low interest rates, and it became very difficult for insurers to really offer products that offered, good value to consumers, good return on their investment. But kind of going back a second and thinking about some of these products that we talked about and when they became popular and what was sort of the favorable products of the day. So variable annuities were certainly very popular back in the 90s. The market was just kind of going gangbusters. It was a very good decade for the S&P. But then when we turn to the volatility of the early 2000s, purchasers were very concerned seeing their, if they were just fully invested in the separate account and they lost nearly half of their investment potentially over a period of time, that was scary, and they were attempting to get out. And fortunately, insurers did respond by saying, okay, what kind of products can we develop to sort of address this? We want to provide some element of protection for these folks that are investing in the market. And that's when they came up with the guaranteed living benefit concept and guaranteed living death benefit. That, okay, you can invest in the market and you can watch it grow. We will promise you that by the time you are actually ready to sort of take your, at retirement age at 65 or in 10 years, say, there was usually a limit, some minimum length of time you needed to hang on to, sort of allow the market to react to your accumulation before you started taking money out. This was very appealing, and that was sort of the explosion of variable annuities with guaranteed benefits. And those were very popular from the early 2000s up till around 2008 or 9. And what happened there is more of a result, I believe, of the blue line trending down. It became very expensive. In addition to their interest rates dropping, it became there were some regulation changes that had additional requirements on variable annuities because they were just very risky products from the insurer's perspective, and they had to kind of make sure that they were reserving and holding enough capital for them. What happened in 2008 as rates continued to drop, it became a little more difficult for insurers, more costly for insurers to purchase the hedge assets that they needed to guarantee those payments. So they definitely, you can see variable annuity kind of fell out of favor a little bit there in 2008, 9, and 10, and 11, even 12 trickled down some. It's kind of hard to tell with that scale, but so in this case, while they had this, insurers stepped up and have this, very good product for the purchaser and the consumer, it became very costly for them to, sort of continue to sell a lot of it. So they kind of dialed it back, the sales of that product. And then what happened, again, with interest rates being very low, your sort of traditional fixed annuity product, the first one I had back in my chart, rates were, what were they? to 2%, 3%. They just couldn't earn, it wasn't enough to beat inflation, honestly, over to invest in an asset that is really at or below inflation. It's just not appealing to the consumer. So that's when fixed indexed annuities gained favor. And that's sort of the era where, after 2008, 9, and 10, sort of through the teens, fixed indexed annuities sort of really came onto the scene, because you could invest in the market and you had a floor, you had a zero, maintained your principal, you had a zero crediting floor, and companies could invest in hedges necessary to sort of sell a lot of that product. So that was sort of, as we look through time, you can definitely tell, okay, things that were happening in the market and kind of consumer sentiment are just very important driver, obviously of annuity sales over that time. So let's keep moving through time here. 2018, 19, 20. It's pretty striking that as we hit COVID, you can see that blue Treasury line drop down to very near zero. In fact, one of the Treasuries, I think very short term, was negative for a period of time. But the 10-year Treasury was down below 1. I think it was 50 basis points. But then something interesting happened. As you got through 21 and 22, you can see how rates really rebounded. That's when the Fed started ratcheting back up rates due to inflation. Again, events in the market driving annuity sales. Look at that purple fixed annuity line. Folks really jumped back on board with fixed annuities at that point, because suddenly they became very viable and they were getting a much better return, and at that point, so it became an easier sale. So that's kind of where we are today. I'm make sure I hit all those points I wanted to. Yeah, I think kind of the real point of that, and the point of that, those couple of slides, is just trying to understand how financial markets just really influence annuity sales, and insurers kind of wanting to react to purchasers' concerns with what's going on in the market. So, they adapt to changing markets and consumer sentiment. I don't think it can be said any differently really than that. It drives innovation. Again, the innovation of, the products with guarantees. Hey, I don't like seeing my savings, my retirement savings, get cut in half. Well, maybe that account can get cut in half, but if it doesn't affect what I'm actually guaranteed out in the future, then if for retirement planning purposes, that's a pretty strong message for a consumer to receive. Market volatility drives benefits, and then interest rates' recent return to more historical levels has really impacted how products. The products that have come out there. Okay, now we'll kind of switch over to the different product features and riders, and I think the thing here, everybody realizes that in order for hundreds and hundreds of insurance companies out there, all trying to sort of have their product stand out among that, they're going to start putting bells and whistles and features, and there are some of the more popular product features that are out there. Right now with the fixed products, there's a real push for bonuses. If you'll purchase, give us $100,000 of your retirement savings, we'll give you a 10% bonus, a 20% bonus even. Now that's not, hey, here's 20%, we'll hand it to you. It gets credited to your account, and you sort of accrue that over time, and you don't actually earn that until some point out in the future, maybe 10 or 20 years out in the future, that you actually earn that full amount. They might offer additional credit rates, to kind of buy into, a higher rate. I guess credit rate buy-ups or cap buy-ups. What you can do is, for an additional charge, a company will raise the cap. Remember, we talked about the cap being at one level. Well, if you give them an extra number of basis points of fees, some additional fees, they're willing to purchase the additional hedges needed to give you a little higher cap or a higher participation rate. So again, these are just some very simple examples of how companies are really trying to differentiate themselves. Inflation protection, again, over the last few years when inflation really kind of came back to the consciousness here, that was a real concern. So companies like, hey, we're going to go after that. Here, we'll make sure that you're tied to inflation, or we'll make sure you're credited something amount that kind of addresses that concern. Multi-year, excuse me, multi-year guarantees. These are, you might have heard the term MYGA, multi-year guarantee annuity, where instead of just crediting or making a guarantee on a single year at a time, like the more historical fixed annuity, you're going to say, well, I'm going to guarantee for 5 years, 7 years, 10 years, I will guarantee this rate that's kind of available to us today. So that does take a little more risk off, and it's very appealing to purchasers with trying to kind of grow their retirement assets. Proprietary indices, these get very complicated, and it's can be difficult to fully understand them. But insurers work with particular investment banks and places where they kind of dial into a particular type of return, and there's examples out there that are kind of hard to describe, but there's certainly things that, again, companies try to do so that they differentiate themselves and kind of show us at point of sale. This last one I just kind of threw on a bit of a whim. As I said, nearing retirement age, you get these cards in the mail, and my wife and I, we actually went out and signed up and went to one of these sessions where they educate you on what you should do with your retirement assets. And this one had a particular focus on Roth conversions. That was kind of his thing that he was thinking. And of course, there was no obligation and no sales, but he was willing to, if you signed up, to go meet with them to kind of show them where you were at with your retirement plan, give you some free advice, and he wouldn't sell you anything. But he did, of course, offer me the opportunity to buy this Roth conversion IRA, where it actually, and again, I think there's some appeal to folks out there who have a lot of tax deferred savings, trying to work through efficient tax payment, and again, Roth conversions is a way to do that. That an annuity product is out there. There's a couple of companies I learned that actually manage that for you, and you can sort of get to the end of the year and say, okay, I want to convert this much, and their admin system will do that conversion for you and keep sort of pre-conversion and post-conversion money, track it for you. I thought it was pretty fascinating. Like I said, there's not a lot of it out there, but these are the kinds of things that companies are thinking about, and honestly, purchasers are thinking about that. Oh, how can I efficiently, get to my retirement funds with good crediting so that they grow, and then when I start taking them out, I'm not getting taxed at too high a rate. So here are, let's talk a minute just very briefly here about the variable annuity riders. These are, again, they came up early in the 2000s. Kind of first thing was they wanted the guaranteed minimum death benefit, just as you would expect. Hey, even if the market's down, you're not going to lose your principal. You'll get that at the point of death. And it's really more than just your principal back. In all of these cases, companies were crediting, we'll credit 5% a year or some percent a year to grow your base. Your account didn't grow by 5% a year, but the amount that was used to determine your death benefit on that at death would grow by that amount. And that's something to kind of keep track of here. There's always this idea of your actual account value and something called a benefit base, which is what your income benefit or your death benefit is based on. So guaranteed living benefits, and that's sort of the generic term of the one below. You're going to have a living benefit. You're going to guarantee that it will accumulate to some amount. Okay, again, it's your large bag of money. You guarantee that at some point, even if your account goes on and does whatever, I promise you that the benefit base will accumulate to this amount, and that's what you'll actually have at some point in the future, retirement age or beyond. Guaranteed minimum income benefits, those are ones that actually guarantee an income stream. Similar to the last one, a guaranteed living withdrawal benefit, which is probably the most popular. They actually, your account does whatever, it grows, you have access to your account value if you need a sort of, a lump sum of any of that. But you have a base that grows to some amount, and then you take a percentage withdrawal depending on your age. So if you're 65 and you want to start taking withdrawal, you can maybe take 4% of your benefit base. If you're 66, maybe it's 4.5. The older you get, the larger the percentage you can, the companies will allow you to withdraw out of that. So that's, I think these acronyms get thrown around a lot. I just wanted to make sure you kind of understood what each of those were. Fixed index annuities, and I think that's, there's some training. I think Fred's going to talk a little bit about how these work, but these are sort of very popular, again, sort of after in that period when interest rates were very low and folks were looking for some alternative away from the risky variable and potentially expensive variable. Again, companies were unable to sell those guarantees after, very efficiently after a point. I think they're actually coming back a little bit now because, again, rates have gotten up to a point where they can start efficiently providing those guarantees. But fixed indexed annuities, these are, as I described early, based on an index. You have they're fixed, so you're not concerned about losing principal. There is a surrender charge period, very common, that maybe you'd have if a year in and you need your money back out, you will get charged back kind of the expenses that the company incurred, and they do that by charging a surrender charge, say 10% in the first year, and then it would trail down to a point where it goes away. The caps and floors I kind of described before, and participation rates, those are all very common to fixed indexed annuities. Multipliers, I haven't mentioned this. Those are interesting in that if, and I've best described in an example, if you might purchase an annuity, fixed annuity, again, with the fees associated with it, the company will turn around and buy hedges that will allow you to earn a multiple of what the S&P, for this example, would return. So say the S&P is up 20%, and you have a, say 25% multiplier, well then you'll actually get credit 20 times 25%, or whatever 20 times 0.2, an extra quarter is. So that's about 25%. So you actually earn higher than that because you've purchased this multiplier. You've actually earned higher. The baseline zero protection is still there, but you're actually getting a bigger multiplier bonus. And then bonuses I've described before. So I think that gets to the end of this one, and I hope we've given you some time to.
Okay, thanks a lot, Pete. I just want to say I'm overwhelmed by the amount of features that are annuities when it's presented like that. And I think that's why we're having this workshop today is just, you can imagine a lot of us have various levels of insurance expertise, but you can imagine what it's like being a consumer. So I think one thing I've learned over the years is, I think there are a lot of insurance companies that are well-intentioned, and a reason that a lot of these complicated features and added features have been added to annuities is to try to kind of sweeten the deal for consumers. A lot of them were developed when interest rates were extremely low, and just selling a vanilla annuity just wasn't going to work. It's like, hey, give us all your money and we'll give you like 1% to 2% interest per year. It's just, that wasn't going to result in sales. So from our standpoint as regulators, we're always concerned about some of these complications leading to opportunities to mislead consumers, because who can really, fully understand this stuff? So we have one layer of protection in regulatory reviews. So our eyes are always open for some of these features potentially leading to misleading situations. A lot of times we'll interact with insurance companies on this, and they'll reassure us, okay, here's why this is going to lead to additional potential upside as opposed to just perceived upside, which would be kind of unacceptable. So it's really the risk return trade-off. So if you remember Pete's line graph, we want to make sure the combination of the features and the charges place any type of product appropriately on that risk return spectrum. So this leads to the importance of disclosures. Obviously, a lot of these products are kind of overwhelmingly complex to explain to potential contract holders. And so disclosures frequently accompany the sales process. This is especially important for contracts that may involve multiple options for the policyholders. Pete mentioned a lot of them. There are annuities with guaranteed lifetime withdrawal benefits that are extremely popular. And some of the options, even after you purchase the contract, could be opportunities to switch between indices, switch between funds, switch between investment options, take out guaranteed withdrawals. Every year you could surrender, you could perhaps take out loans or use a base and annuitization option. So the disclosures allow policyholders to better understand how the future of their contract could look when choosing each of these different options. And basically, a lot of the information provided to the consumers is, okay, if you take these options, here are what's the cash flows could look like, interest credited, what would that look like, and potential cash values, which may differ from account values after you net out the surrender charges. Some of the basic information typically provided in disclosures include identification of the insurance company, description of the product, list out the contract holder. There'll be a written description of certain contract features, the benefits, the guarantees, and riders, an explanation of how charges are applied, and definitions and language that help facilitate a consumer's understanding of the product. Many of the disclosures include projections, so it may look a lot like a life insurance illustration. It'll show the contract mechanics, the benefits, cash surrender value calculations, and how they work. In addition, the disclosures may show historical returns for indices included in the contract, as well as the resulting index credit amounts that may have been provided over time, looking back and potentially going forward. And I'll provide an example. This is kind of part one of what a disclosure would look like. So it'll show the owner and, things about the owner, things about the salesperson, contact information, date, state of issue, contract number. And then in the definitions section, this is especially important as reviewers of these products, just to make sure that everything, first of all, is as plain language as possible, as understandable as possible, and also that what's defined, in words is portrayed accurately in numbers and will result in kind of the definitions leading to, accurate information, both at purchase and along the way as the policyholder has their annuity experience. So one of the key definitions is the guarantee. There's typically a minimum. Some of them are defined in law, especially for fixed annuities. It might say, okay, if treasury rates are at a certain point when you purchase the product, the minimum guarantee must not be lower than some formula based on the current treasury rate. And then the company may go over and above what the law requires to provide additional guarantees, either at the beginning or over time. The savings potential is something that's discussed in the disclosures. So with the very popular index options, how does that translate to accumulated cash value over time? To me, the most important thing to review is the downside and making sure the consumer understands it. So if a product actually has a 0% floor and interest credited, that should be accurately described. But if a product does have a downside, that to me, that's the most important thing a consumer needs to understand is the potential that they may lose money and how much they may lose. Especially Pete mentioned the RILA products, and the two variations are very different. And one of them, you may only have the potential to lose 10% of your money, but in the buffer design, you may lose 90% of your money. I mean, the stock market's probably not going to zero, but there is that potential that you could lose a lot of your money. So to me, that's probably the most important thing defined and explained in an annuity policy is the potential downside. The tax deferral will typically be explained. The various ways in which you can attain income, whether it's annuitizing and kind of locking in lifetime income, or as Pete mentioned, still having a product where you're withdrawing a little bit of a time, but do have access to cash value if you need it. That'll be described. And then these products also contain a death benefit that may or may not contain a guarantee. So another part of the disclosure, especially with the index products, is a list of all the various options. And, if you've done like deferred comp or something like that, 401k, you've probably seen these types of things. So this gets really interesting because, there are different types of people who sell variable products versus fixed products. And many of the index products are in the category of fixed. And there's kind of a lower implied level of expertise required to sell a fixed product versus a variable product, as far as like dealing with volatile indices or volatile, funds. But I guess it's kind of accepted that for fixed index products, there are going to be these types of options. And, in some cases, the policyholders may be on their own as far as understanding the potential risks associated with the S&P 500 and, small cap and these various funds. The good thing about the index products is the zero floor. And so even if a person buying a product and the salesperson doesn't totally understand the risks and returns of these funds, there is that protection that they will not lose money. So I think that's why it's been acceptable for these index products to kind of take off in the fixed category. Also in the disclosures, it'll mention a lot of the things that Pete said, what's the cap, what's the floor, what's the participation rate, bonuses, charges, so on and so forth. And this is something we'll zero in on during our product reviews, is making sure, for instance, the 0.15% charge is reasonable in light of the potential upside and potential downside of the product. And then, for actuaries, this is our favorite part. We finally get to a spreadsheet looking thing. And it's like, okay, all that payoff, we had to read all those words. And it's like, we finally get to what we're looking for. So this is a very common example of what's presented to consumers. And you got the premiums, you got the charges. And there might be very different variations of this spreadsheet, one where the policyholder does not take withdrawals, one where they do take withdrawals, how that impacts everything else. Interest credited in terms of percent and dollar amounts, account value, and then a cash surrender value, which is just the account value minus the surrender charge. So this is projected for a number of years. And again, if the main thing to me is first of all, the policyholder to understand the downside of the policy. So if they're shown a bunch of these types of charts, is one kind of prominently displayed that will show, okay, this is something bad that could happen during your years. You know, if you have an index product and we have a few bad years in the S&P 500, you know, potentially these numbers could look much worse. So that's a big thing we're looking for, is not just the rosy scenario, but also kind of what could go wrong. Of course, you know, these numbers could be presented in what's, you know, shown to us as disclosures. And a key thing is, you know, at the kitchen table, what's actually being described and explained to the consumers. But from the things we have control over, we like to see the consumer, if all this stuff is actually presented, that it would show the potential upside and especially the downside of the product. So then we have requirements. So this is where it gets interesting, where there are much different requirements for life versus annuities, even though a lot of these you know, product features, especially on the index side, are very similar. We have an NAIC Model 245 annuity disclosure model regulation. It was adopted in 2013, was updated in 2021. Provides requirements around annuity disclosures. So it requires a disclosures document and buyer's guide that provides definitions, descriptions, and examples of contract features, including benefits, charges, and guarantees. It requires features that must be explained in the combination of the disclosures and buyer's guide. These include the interest credited, index parameters, income payment options, guaranteed versus non-guaranteed elements, what happens after withdrawals, and the benefits of the annuities. So from the model, any illustration must show projections of premiums, benefits, and charges over time. And a key aspect is that non-guaranteed elements must not be more favorable than current levels. So an example of a non-guaranteed element is credited interest rates. So the insurance company has flexibility and control over what credited interest rates will be in the future. They can't go any lower than the stated minimum in the contract and the law, but they'll have various incentives to provide higher credited rates. An incentive for them to provide higher credited rates is so the policyholder doesn't surrender and go to a different insurance company. So we don't have much control over that, but as far as at the initial sale, we want consumers to know that you know, if a company is projecting, hey, the minimum credited rate's 2%, but we're going to show you a projection showing only 5%, that would be something that would be inappropriate. There needs to be an understanding that the company would be able to control lowering the credited rate over time. So in addition, the company is required to show 3 scenarios. Is required to show the most recent 10 years, the most and least favorable 10-year periods within the last 20 years also have to be presented. So that helps ensure it's not just the rosy picture that's presented to consumers. So this model is not applicable to annuities with no non-guaranteed elements. And it's also not applicable to certain annuities used for retirement accounts and also for tax-exempt organizations. It does not apply. As I mentioned, there are 2 key issues that I see. One is we don't want to see a company providing overly optimistic projections. We want to see that the actual risk of underperformance is presented. And also an issue that's come up is it's called backfitting of indices. So, you know, it's possible that an index, you know, created given the knowledge of the past, could look wonderfully in a projection if you're like, okay, history is going to repeat itself. So there's kind of been a crackdown on companies doing that, kind of engineering an index that, given past knowledge and repeating that past, would look wonderfully, but in reality would have a lot of risk. Then wrapping up, a few of the regulatory concerns. Unlike the life insurance model regulation, which has been largely adopted by states, fewer states have adopted Model 245. There's some concern about indices with less than 10 years of experience illustrated. This can lead to concerns about backfitting. Currently, there are no actuarial guidelines or actuarial standards of practice that apply to annuity illustrations. So it's different than with life. So this is all making it difficult to strategize on next steps at states at the NAIC. So a project to address issues will likely take a long time and take up a lot of resources when there are a lot of other issues going on. But it seems like there is some interest in moving toward some activity at the NAIC in this issue. So that concludes everything, and I apologize for...
I think when we thought about this, we would be short on time, but here we are at time. We're out of time. Thank you all for coming. Thanks, Fred. If you have questions, we'll have to stick around and talk to you about that. So thanks.